In this video, we're going to provide an overview of financial accounting and the two types of questions that accounting attempts to answer. The first question is, are we profitable? And the second question is, a job or particular product profitable? The first question, are we profitable, is the primary focus of this course, financial accounting, while the second question, is a job or product profitable, is more the purview of cost or management accounting. When we talk about profitability, we're basically talking about revenues and expenses. If our revenues exceed expenses, we have a profit. And of course, if expenses are larger than our revenues, we have a loss. When we think about accounting, there are really two different forms of accounting. There's cash basis accounting and accrual basis accounting. Cash basis accounting is really very simple. We record revenues whenever we receive cash, and we record expenses whenever we pay out cash. For instance, under a cash-based accounting, the cost of a factory would be recorded as an expense the time that factory was built or purchased. Now that can be sort of problematic because we've got this great big cost in the first year, but no cost in subsequent years as we use that factory. Or what if you were an Uber driver and you bought a new car? Well, you would record the cost of that car as an expense in the year you bought the car, but in all the future years when you were using that car to generate revenues, you really wouldn't have any costs other than the cost of repairing the car, gas, and insurance. And that doesn't quite seem right either. So let's consider another example. Say we buy products in September, and we then make a sale in the month of October. And finally, in the month of November, we collect cash from the customer we made the sale to in October. Under cash basis accounting, we would have a great big loss in the month of September when we bought the products because we have no revenues coming in, and we would record an expense in the amount of the cash we spent on our merchandise. In the month of October, when we make the sale, if it's on credit, we would show nothing happening, neither revenues nor expenses. And then, of course, in the month of November, when we collect cash, we would report a revenue, but we wouldn't have any associated expense because we recorded that back in September when we purchased the product. Now, accrual basis accounting tries to overcome this problem. We try to record the revenues and the accompanying costs in the period which we make the sale, which would have been October. So in October, we would have reported revenues, even though we didn't collect cash from our customer, and we would report an expense for the merchandise, even though we bought it back in the month of September. So again, accrual basis account, we try to match revenues with expenses. Now, if we had long time horizons, cash basis accounting would be fine because that factory we built or purchased in 1951 and recorded as an expense in the period we paid the cash, it would have long since expired by the year 2000 over this 50-year period when we're making or reporting our financial information. The inventory we bought in 1953, hopefully we would have sold by year 1960, and clearly if we made a sale in 1960, we would have collected it by the year 2000. So you see, if we have long accounting periods, cash basis accounting is fine because typically the cash and the actual transaction will take place within that long time horizon. But if we want to find out or report on information in shorter time horizons, say annually, quarterly, monthly, we're going to need to use GAAP, generally accepted accounting principles, which follows sort of this notion of accrual basis accounting, which is going to try to record transactions in the period in which they occur. So again, GAAP, which is our fundamental principles underlying our accrual basis accounting, which is what we're really focused on in this course, we're going to record transactions when they occur, not necessarily when cash is paid or received. We've got two primary rules in accrual basis accounting. The first is our revenue recognition principle, which basically states that revenues are recognized when delivery has occurred or we've performed services for our customers. It doesn't matter when the payment is made or received. For instance, you might have a prepaid phone plan. Well, you pay the phone company for those minutes ahead of time. they actually don't have revenues until you make calls. In other words, they provide the service. Or perhaps you have a phone plan where they bill you after the fact. Well, they record the revenue when you're making those phone calls. In other words, when they are providing the service. It doesn't matter when payment is received. Another example would be Millersville University. You've already paid your tuition for the semester, but they don't have a revenue until the services are performed. In other words, until I hold classes. So over the next 8, 10, 15 weeks, they will start to report revenues, even though you paid the cash before the semester even started. The second underlying concept of accrual basis accounting is our matching principle. In our matching principle, we record costs, or we basically try to match costs with the revenues they help generate. So when we incur a cost to generate revenues, we're going to record them in expenses in the period in which we report the revenues. And again, it's regardless of when cash is paid. Going back to our earlier example, we purchased the merchandise in September, but we didn't make a sale until October. So we recorded the cost of that merchandise as an expense in the month of October. And we reported the revenue in October because we delivered the services, we delivered the goods, even though the customer didn't pay us until the month of November. When we consider costs, we can think about period costs as being costs that don't provide any future economic benefit. And these costs are recorded directly as expenses in the period in which we're incurring them. Think about sheets, the person working the cash register. Their salary doesn't generate any revenues next week or the week after or the week after, so we record their salaries as an expense in the current period. The electricity for operating the lights, the register, the gas pumps, again, that isn't providing any future benefit. It's generating revenues today, so we record them as expenses in the current period. We refer to these as period costs. Remember our definition of assets, something that provides a future economic benefit? Again, period costs don't provide a future benefit, so we record them as expense in the current period. We incur other costs, for instance, the cost of inventory, the cost of rent, the cost of fixed assets. We capitalize these costs, and capitalize simply means record as an asset, because these costs will provide a future benefit, and we want to match their cost with the future revenues. Now, the matching of cost with future revenues for some costs can be pretty easy. For instance, the cost of inventory in a sheets, that cost of the chips, the cost of the soda, the cost of the beer in the freezer, all of those costs get recorded as inventory when we incur them. And matching them with revenues is very simple. Someone grabs a beer out of the freezer. Someone grabs chips off the shelf. When they go to the cash register, we record a sale and an expense at that point in time. The gas we buy from the tanker truck, we record that as inventory, and it sits in the tank until someone pumps it out. And when they pump it out, we record a sale as well as an expense at that point in time. The rent for the month, we record that as an asset because it's going to generate future revenues. The matching of that is pretty easy as well. If the rent is for 1 month, we just allocate it evenly over time over the course of that month. Now, the cost of fixed assets, the cost of that gas pump, the tank in the ground, the shelves in our store, the cost of the cash register, the cost of the building themselves. Those are fixed assets. And again, when we incur that cost, in other words, we buy that asset, we record it as an asset on our books and match it with future revenues. The matching process is somewhat more difficult. We're not sure exactly how many years that cash register will last. Will it last 3 years? Will it last 5 years? How about the shelves? Will they last 10 years? Will they last 15 years? What about the building? Will it last 40 years? 50 years? How long will they last? Those require estimates, and that makes the allocation of costs over time more difficult. But again, to answer that first question, are we profitable? We simply need to allocate costs over time. We apply the revenue recognition principle, which means we record revenues in the period we provide the service or deliver the goods, And then the matching rule, which says we try to take the cost of generating that revenue and record it as an expense in the period in which we record the revenue. We'll focus on that primarily in chapters 3 and 4. Now, the second question, is this job or product more profitable? It's much more challenging because not only do we have to allocate costs over time, but now we're going to have to allocate costs between products. This is the primary focus of management or cost accounting, which is the next class you'll take in your accounting sequence. So that second question, which product is more profitable, is much more difficult. Sheet sells hundreds of products. How does it set prices? Which products are most profitable? Which is more profitable, a gallon of milk or a gallon of gas? To answer that question, we need to examine the difference between direct and indirect costs. The cost of acquiring a product is a direct cost, and it's easy to match with revenues. The overhead costs, such as labor, electricity, shelf space, those are all indirect costs and are much more difficult to match with revenues. Consider, for example, the cost of electricity at a Sheetz. It doesn't take much electricity to sell potato chips. They basically just sit on a shelf. On the other hand, there is electricity cost that is rather considerable when we think about pumping gasoline or refrigerating drinks or operating soda fountains or the roller grill areas. So it's difficult to think about how should we best allocate the cost of electricity. How about the cost of labor? When we think about pumping gas, typically the cashier isn't involved, but selling a bag of chips, taking an order for a sandwich, selling a soda, that does require labor on the part of the cashier or staff within the store. So it's challenging to allocate those overhead costs to particular products, but that's going to be the focus of managerial or cost accounting. And finally, the challenges will even get greater when we consider manufacturing companies, which, unlike retailers, don't purchase finished goods for resale. They incur costs in making a product. Initially, the cost of manufacturing a product is recorded as an asset. So all of the direct materials, the direct labor, the manufacturing overhead will get recorded as an asset. Then subsequently, when the products are sold, their costs are matched with revenues, and the firm will reduce assets, inventory on their books, and record an expense, which will be cost of goods sold. So again, financial accounting is primarily geared towards answering that first question, are we profitable, which requires matching and allocating costs across time. And that second question, is this job or product profitable? That's going to be the focus of managerial accounting, which will require the allocation of costs both across time and between products.